So, just to review, in part one, we introduced the idea of opportunity cost, cost of capital, discount rate, this massive invisible cost that we all have that businesses know how to account for, but we in our own personal economy oftentimes don't account for this massive but invisible cost. So, when we spend money or use our money in any way, the cost is not just the cash cost on day one, but all of what we could have earned on that capital had we been able to save it. So then we talked about how we could potentially recover opportunity cost, where we still have to spend our money, we still have to utilize our money. We cannot print money out of thin air like the Federal Reserve, but we can still earn on that money. So we still have the cash cost, the today cash cost, but what we recover is the opportunity cost. So we use the money, but meanwhile, we can keep earning on that money at the same time. So, how do we do that? Well, as we showed, we utilize specially designed cash value life insurance policies where we pay premiums into our policy like it was a bank account. But then when we want to utilize the money, we don't withdraw anything. We simply borrow against it using what's called a policy loan. Meanwhile, our entire cash value keeps earning for us. We talked about how a policy loan is not a debt, so there are no repayment terms on that loan whatsoever. So you can use your money via a policy loan. Meanwhile, your entire cash value keeps earning for you in the policy at a safe, guaranteed, tax free rate. Plus, you have the death benefit protection, plus creditor protection, plus long term care protection in that policy, plus the psychological benefit of certainty. Um, but it is advisable to pay yourself back, even though it's not required, because you're just recapitalizing your own banking system. You set up your own private bank. You want your bank to be profitable. And so then you start a continuous cycle of paying premiums into your policy, borrowing money out via a policy loan, and then paying yourself back plus interest, recapitalizing your policy. So now let's just go through a very quick short example of what this might look like. So we're going to look at an example with an actual specially designed whole life policy. We're starting it in year 10, and this policy will be fully paid up, meaning no premiums are due. I don't necessarily recommend designing a policy this way. It's much simpler for illustration purposes. We won't have premiums going in or anything like that. It'll just be very simple. The policy is fully paid up. And this is how the policy grows starting in year 10. You can see the cash value grows from about $100,000 to over $300,000. The death benefit grows from about $200,000 to about $400,000 over that multi-decade time frame. This is without you paying any additional premiums or doing anything at all. So this is what your policy looks like if you never touch the cash value, if you never use the money. It's just like a savings account with a leveraged death benefit. But what if we do use the cash value? What if we want to use the capital that's in our policy? Well, here's how we can use the cash without interrupting the growth in the policy. Here you see that same policy, except now we've taken out a policy loan. So we take out a $10,000 policy loan from this policy, and then we pay ourselves back over multiple years to approximately $2,000 a year. And notice how our cash value grows to the exact same amount as before, $314,000. Our death benefit is also exactly the same as before, $399,000. So our policy grows completely unaffected even if we do use the cash value via policy loans. So this is just one simple concrete example of how you can keep all of your capital earning for you even while you're using it. So instead of storing and using your capital from the standard banking system, you can store and use your capital via your own private banking system, namely specially designed whole life insurance policies. And I emphasize they do need to be designed properly. This is not just any whole life insurance policy. You need to be working with someone like myself who knows what they're doing, who knows how to design these policies, and who knows how to advise you on structuring policy loans and structuring repayments to your own policy. That's a whole skill in itself that's outside of whole life insurance. Depending on what you're using that policy loan for, might dictate how you want to pay yourself back, what that schedule might look like, and how it's going to be most advantageous to you. But of course, no repayments are required. This policy would grow exactly the same if we never made any repayments. It's just the death benefit would be reduced when it's paid out. So with infinite banking, we are recycling our capital rather than spending it and using it.